At some point, almost everyone who works from home hits the same confusion. They hear that the home office is risky, or small, or not worth it. So they either skip it completely or they take it halfway and hope it doesn't matter. It's about whether the home ever shows up as part of your business at all. Most people who think home office is a deduction, it's not. It's not just a deduction, it's a classification. When it's done correctly, a portion of your home shifts from personal use to business use. That single shift changes how the tax code treats your housing costs and how other deductions are attached and whether other deductions are even allowed. That's why this is a foundational move, not a side tactic. In this video, I'm going to show you what a home office actually changes on your tax return, not just what it deducts, but what it unlocks. By the end, you understand why the move quietly determines which expenses are even allowed. Most people think that the home office is about writing off a desk or a chair or a couple $100s. That's not what makes it powerful. The real value of the home office is that it changes the character of your home for tax purposes. Not all of it, just the portion you actually use for business. That distinction matters more than people realize. When a home office is set up correctly, it allows you to allocate a portion of rent or mortgage interest, property tax, utilities, internet, repair and maintenance, insurance, from personal use to business use. That shift alone can reduce taxable income. But more importantly, it unlocks deductions that doesn't exist without it, that the IRS disallow without it. There isn't one right way to do the home office. There's three compliant methods. The first method is a square footage. You calculate the business use square footage as a percentage of the home. Simple, common, works well for consistent office space. Method 2 is a safe harbor, a flat rate per square foot capped by the IRS, lower audit friction, lower deduction ceiling. Method 3, the room-based allocation, used when specific rooms are dedicated to business use. Less common, but powerful when done cleanly. The methods matter less than one requirement. The space must be regularly and exclusively used for business. That is a non-negotiable. Let's keep it simple. You work from home. Your home costs $36,000 per year, all in. Rent, utilities, internet, insurance, combined. Your office is 12% of the home. That allows you to allocate roughly $4,300 as a legitimate business expense. At a combined tax rate of 25%, that's roughly $1,000 plus in tax reduction. And that's before we even talk about how this straightens our other deductions. This is where people underestimates it. The home office doesn't just save taxes on its own. It supports business travel, vehicle deductions, phone usage, internet, repairs tied to business activities. Without a home office, many of those deductions are partially or fully disallowed. It's just harder to justify. With it, they fit into a coherent business narrative. That's why experienced business owners don't skip this move. They know it makes everything else cleaner. The two mistakes people make. They don't take it at all because they're scared of audits, or they take it aggressively without documentations. The IRS doesn't audit home office because they exist. They audit home office because it doesn't make sense. Clean space, consistent use, clear records. That's it. For most business owners, the home office saves about $3,000 to $10,000 per year over time, depending on housing costs and tax brackets. But the real value isn't the number. It's that your home stops being invisible on the return. And that's when tax starts to feel intentional and not random. The next move isn't about squeezing deduction. It's about changing the role of your home inside a tax system. In the next move, we're stepping into one of the most misunderstood strategy, how certain homeowners can legally move money from a business to personal without paying tax on it. That's move number 4.